Hey guys, Max here, and yesterday we saw the end of the trading week, the first week for over 2 months that actually ended up with markets higher than they were at the start of the week. Now, lots of people are, of course, very excited about this, as you might expect. 2022 has been a very rough year for people in risk on assets, and some people think that this is the end of that correction, that the pain is done, and the bull market is about to take off once again. That's not exactly what I think, but it is what some people think. So what actually happened yesterday in the markets? Well, American equities were up, less than they were earlier in the week, but still not by a small amount. The S&P 500 rose by 1.17%, and the Nasdaq rose by around 2%, so tech stocks led the charge. Now for the week, the S&P 500 is now up 6%, and the Nasdaq up 8.5%. Both are still way off their all-time highs. The Nasdaq's down about 13% from its all-time high, and the S&P is down 7%, so still far too early to be shouting for a bull run in my opinion. Now, American equities, their growth slowed down a little bit more, but again, we have the same sort of story, gains across the entire week, not just yesterday, just a little bit less than in the US. The FTSE 100 rose 0.3% yesterday, quite poor, and up 3.5% for the week, and the Stoxx 600 was up 0.9% yesterday and 5% for the week. Now, why were stocks actually green? Well, no one really knows. Everyone is scrambling for different ideas because nothing really makes sense here. Maybe the markets are still happy on the Fed's dovish and slow interest rate hikes of only 0.25% as opposed to 0.5%, but that was now a few days ago, and the markets shouldn't really still be reacting to that. Maybe markets are liking this media noise about negotiations going well in Ukraine, but it's all completely unconfirmed and unsubstantiated in my opinion, so it shouldn't really be that either. It is possible that the markets are watching the war in Ukraine itself, and the fact that there's been hardly any progress made by Russian forces over the last week or even 2 weeks at this point, so maybe markets are expecting the war to slow down. The war has already slowed down substantially, and there's loads of intelligence from Western reliable intelligence organizations like the Ministry of Defense here in the UK saying that Russian forces are running out of offensive capability. The problem with this idea is that if the Russian forces are unable to invade conventionally, there's a good chance they will just continue to fire rockets and kill civilians, escalating the conflict that way. Rumors of hypersonic missiles being fired earlier today came out, and if true, then that is a perfect example of this kind of escalation, and it shouldn't be good for markets, but who knows if that's really true or not. Right now, I literally read about that half an hour ago, so I don't know for sure. That much I do know. Now, the market rally started on a drop in energy prices, quite a sharp drop as well, but they've started rising again. So that shouldn't really be the reason for the strong market performance at the end of this week. The reality is, this is the inefficient markets at work. It doesn't really make any sense. Right now, when we have market routes, we tend to have specific pieces of news or developments that drive those routes, and it's easy to connect the dots. But when markets rise, we don't always have that specific cause. Sometimes it's just weird investor sentiment increasing for what seems like no reason at all. It's very confusing. I'm trying to make sense of it all. I'm sure you are all as well. We always say that volatility goes both ways, and we saw that this week for sure. So what's going on elsewhere? Well, currencies have been pretty stable for the most part, except for, of course, the Russian ruble, which fell another 10%-ish after rallying slightly as the war slowed down. Russia did make bond payments required in USD, which was very important. It seemed like they were going to just pay their debts in rubles, which is basically defaulting, and so the government hasn't defaulted yet. Some people are asking how the Russian government paid it. Well, they do still have half of their foreign reserves in their own banks, so it probably came out of there. This is not sustainable long term, though. Problems still remain, major problems with the Russian economy, with their central bank and their debts. And if sanctions stay put, at some point, Russia will default. It's just a matter of time, really. Now, bond yields actually declined slightly. The US 10-year Treasury fell 2 basis points and it now sits at 2.15%, still very high. The German and British 10-year yields fell a few basis points each as well. There have been slight inflows into bonds, which is just a little bit unusual, especially as tech stocks rose a lot yesterday. Now, oil prices are rising once more. It seems there is no rest for the energy markets, but this again seems to just be ignored by equities. Again, I'm not sure why, I'm afraid. WTI crude oil is up another 1.5% yesterday, now sitting at $105 a barrel once more. Brent crude oil is sitting just a little bit higher at $108 a barrel, peaking for yesterday around 110. That's still a really damn high number. It's still going to spike inflation a ridiculous amount and make all of our problems worse. Again though, the markets just don't seem to care. Now, gold prices fell once more, moving in the opposite direction to bond prices, which is unusual. Gold now sits at $1,925 an ounce, nearing in on that $1,900 mark. Prior to the Russian invasion, gold was hovering at around about $1,800, not $1,900, so still high, even if falling from the peaks the other week above $2,000. Finally, in the world of crypto, what's going on over there? Well, we saw some fairly decent gains for the day. Bitcoin was up $1,500 or about 2% to over $41,000. Ethereum was up almost 5% to just under $3,000. Altcoins tended to rise in that sort of range as well, somewhere between 3 and 8% gains, moving in line with risk on assets. There did seem to be some decent sized inflows as risk sentiment increased, but nothing really crazy there. So what happened behind the scenes? Well, Biden and Xi Jinping had a phone call, and China basically reassured the West that they didn't want to get involved in the war in Ukraine. Now, this has been a few days in the works. They mentioned in the past that they supported Ukraine's territorial integrity. They said that they would never attack Ukraine, and it seemed that they've been put off by the sanctions levied at Russia. Now, early on in the war, they were slightly on the other side, cautiously supporting Russia, but that doesn't look to be like the case of it anymore. There are lots of parallels being drawn between Taiwan and Ukraine, but China seems more bothered by maintaining trade relationships and financial markets and things like that than seizing Taiwan right now. It's also worth noting that Russia did literally ask China to help with the war, to invade Ukraine and send their army there, and China basically just said no. Now, there is a chance that this is why markets rose a bit, but again, it just seems a little bit unlikely and unusual. China has been positioning themselves this side for the best part of 2 weeks now, so I don't know why the markets would rally on this specific news yesterday alone. Now, some Federal Reserve members, Governor Christopher Waller, for example, said that the Fed should raise interest rates by 0.5% intervals in future meetings, and that they should start quantitative tightening or selling off their balance sheet in July. Neil Kashkari, another Fed official, said that QT should start next meeting. Now, this is far more hawkish than the Fed actually is right now, and we are expecting inflation to keep getting worse, so this isn't off the books. This should, though, be awful for markets, this kind of news. Quantitative tightening especially should cause bond yields to rise really quickly, and 0.5% interest rate hikes consecutively throughout the year means that we could quite easily see interest rates higher than 3% by the end of 2022, which would be a major shock to the markets. But we're a month away from the next meeting. Financial markets and investors like to make money while the sun shines, so it seems like they're just buying in, ignoring this bad news and chasing profits while they still can. There are, of course, big fears of a recession right now, and rightly so, in my opinion. Markets are just ignoring it for the most part because Yellen and Powell told us that it's not going to happen, but the banks seem less convinced. We need to remember that whenever Yellen and Powell tell us things, they told us that inflation was transitory and that they were 100% sure it would not get worse and it would not persist, but they were 100% wrong. Frankly, I don't see them as an authority here at all because they've pretty apparently been corrupted by their own positions of power and authority. When oil prices spike as they just have, recession almost always follows as so much pressure is placed on every supply chain, every business, every job, every person, everything. Basically, it's very tough to see huge increases in oil prices with no recession coming afterwards. My views on where the markets are actually going right now have not changed. I'm staying with my strategy that has performed well so far this year. I'd urge you, even if you disagree with me, not to change your entire trading strategy on a single strong or bad week. Take a measured approach, look at data, and come to sensible, realistic conclusions. Now, if you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio, and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.